We have some important news about Meta, formerly known as Facebook. First of all, they raised $10 billion in their first ever bond offering. And they need this money for share repurchasing and also investment such as metaverse. They also filed their Q2 results and they're not good. They actually have recorded their first ever quarterly drop in revenue. And there are also significant changes concerning some of the investors in Meta. But does it all mean that Meta is going down? Is it the beginning of the end for Meta? Or is it just a process for this company and they are changing? They are trying to stay ahead of their competitors. Well, let's try to find out. First of all, what's happening with the investors? Well, insider buys, that's an X, there is no movement there. And about super investors, that's a check. And there is actually a lot of super investors invested in this company. And just to name a few, we have Pat Dorsey, Robert Vinal, David Tupper. But at the same time, we have investors such as Michael Berry or Li Lu that sold their investment in Meta in the last quarter. So, as you can see, yes, there are a lot of super investors in this company. But at the same time, some of the most intriguing ones are selling. Okay, so let's see the fundamentals. First of all, return on invested capital. That's a check, and the return is 19.3%, which is really nice because we are always looking for a return over 10%. What about free cash flow growth? That's a check. And it's an incredible growth because this is 45% in the last 10 years. So it seems like Meta is just this money printing machine, right? But let's see share buybacks. That's an X. In the last 10 years, they issued 32% more shares of the company. So on the one side, they are generating a lot of cash for the shareholders, but at the same time, they are diluting them by issuing more shares. But if we look closer into the data, we will find out that they are actually buying back shares for the last 5 years. Just in the last quarter, they spent $5 billion on repurchasing. And as we can read in their recent results, they have $24 billion put aside just to buy back shares. So it's an X for now, but it seems like it can change pretty soon. Okay, what about dividend yield? That's an X. Meta is not paying any dividends right now. And what about the debt of the company? That's a check because Meta is actually one of the only big companies out there that has no debt. Well, of course, now we know they issued bonds for 10 billion, right? But this is something that we do not see every day. And you know, it's really hard to go bankrupt if you have no debt. Okay, what about PE, price to earnings? The current PE is 14.8. So let's compare it to a 5-year average PE. And that's a check because the 5-year average PE is 30. So it seems like we may be getting a really nice deal here. But what is really intriguing that we can do with a PE ratio is to calculate a PEGI ratio, which is price to earnings divided by revenue growth and dividend yield. So first of all, we have to find the revenue growth, and it's incredible. It's 41.3% for the last 10 years. And the dividend yield, is 0. So if we divide the PE by the revenue growth and the dividend, in this case it's 0, so just by the revenue growth, that's a check because it's 0.36, and we are always looking for a number below 1, because that means that the revenue growth, which is 41%, is worth more than the current valuation by a PE ratio. Okay, so let's do a proper valuation with a discounted cash flow formula. So to calculate the intrinsic value of this company, we have to make some estimates. First of all, we will have to estimate the growth for the first 5 years and then another 5 years. And we will make 3 scenarios, a low, a medium, and a high one. So for the low scenario, for the first 5 years, we can estimate 5% growth and then another 5% growth. Then for the medium, 10% growth and then 15% growth. And then we have a high scenario in which we really believe that the company is going to do really, really well. So the first 5 years, 15% and then 20%. And we should always be conservative with our estimates. And you may say, well, 15 and 20%, that's not conservative. And you may be right, even though the company is growing much faster right now. But that is why we have those 3 scenarios. We have the low one of 5. And that seems really conservative if we compare it to the current growth. So, okay, let's see the valuation. So the intrinsic value is somewhere between $216 and $526. But this should not be the price that we are looking for. We should always add a margin of safety. I use a 30% margin of safety. And this allows us to actually make mistakes. If our estimates of the growth are wrong, then still we have a decent chance of making this investment work. So, with the margin of safety, we should be looking for a price between $151 and $368. And the current price is $179. And you may say that $368 is really high with those estimates of 15 and 20%. But you also should remember that around a year ago, the price for one share of Meta was $384. And that they have over $40 billion in cash and cash equivalents. So, is this company changing? Is it trying to, beat the competition and that is why they're investing so much? Or are they in trouble? Are they going down? Is it the beginning of the end for Meta? Well, we will find out in the future. But if you want to invest in this company, remember to do your own due diligence. You have to decide by yourself, is this a company for you? Do you believe that all this investment, all this change is going to pay in the future? Or is it a dead end? That's it for today. Thank you very much. I hope you found this video interesting and helpful. If so, then please like it and subscribe if you haven't already. And see you in the next one. Bye-bye.